Hey everybody, welcome back to the VIP Financial Ed channel. Really excited to be here today. I hope you are as well. Guys, we're going to be talking today about 5 really common myths of lending. This is where you're going out and getting your financing. Don't let these myths affect you. It's coming up next. All right, guys, welcome back. We're here with none other than Mr. Joseph Massey again. He is one of the single most productive rock stars at Castle & Cooke Mortgage. He is based out of here in Denver, Colorado. We've known each other for
a long time.
Long time.
8+ years. Probably.
That's right. You may recognize him from a video that we did recently called 5 Principles of Getting Started in Real Estate Investing, as well as the food drive that we did over the Thanksgiving holiday. So
a lot of fun.
Joe is really involved in the community, and not only is he giving back a lot, but man, the guy is killing it. Something like 250 plus transactions in a year. It is extremely difficult to find real estate mortgage professionals that have that type of experience, and most of it surrounding real estate investing.
Yeah,
so
that's right.
This is a really special day to be able to get him in on any of these topics, and we're going to be bringing him in periodically and giving you guys what you need to know about the mortgage side of debt weapons. So today we really want to dig into some of the most common myths that we're hearing. I'm sure you get bombarded with myths.
Yeah.
And we've noted a few that we hear often that I think are going to be really important for you guys here on this channel. So let's go ahead and dive in. What would you say is one of the most common myths that you hear regarding financing a home?
Yeah, one of the number one things I hear is, well, I don't want my credit pulled because I don't want my credit score to go down. Okay, I get that. Let's talk a little bit about that. And first thing I want to do is I want to ask you a question. You were trained by one of the guys that actually founded the Fair Isaac credit scoring, right?
That's right, one of the original creators of the first algorithm for FICO, exactly.
Yeah, so I've got some things that I want to comment on, but first I want to hear, what are your thoughts when somebody says, hey, I don't want my credit pulled because my score is going to go down? What's your first thought?
Well, first of all, I think strategizing the acquisition of new financing as it relates to credit is incredibly important. So most definitely, this is something that we're extremely careful about. The frequency with which we're applying for and acquiring new debt weapons has to be limited. Otherwise, we will cause short-term damage that will prevent future short-term objectives. It is always temporary. So when we say it's short-term, it is. I mean, eventually, usually it's the most recent 12 months worth of inquiries that are affecting you, and usually it's the most recent 10. Anything more than 10 isn't playing a role in the scores, but still can obviously affect the actual underwriting itself. Understand there are 2 pieces to credit typically. The first is, how is it affecting the scores? And the second part is, how is it actually being perceived by underwriters?
Right.
Not always the same thing. So, we're very, very careful about this, but it's my understanding, and as the FICO models change and are upgraded periodically from one year to the next, this may not be the case as much now, but it's always been widely known that there's something called shotgunning, whereby you can be applying for a number of best case scenarios from a mortgage standpoint in order to get the best interest rates or terms, and therefore within a specific window of time, usually we're talking weeks, not months, your credit will be impacted by only the first inquiry, not subsequent inquiries during that window. Does that still remain the case?
I would agree. I would agree. And the one thing that I tell everyone is, number one, you're wanting to buy a new house or a new rental property, we're going to have to pull your credit.
Right.
Like, I can't just say, oh yeah, Matt, I know Matt, he's good for $200,000. Yeah, just let me give him a letter. All right, we're going to have to see your letter, or we're going to have to see your credit before we can give you the letter. All right, number one, you're going to just have to get over it that your credit score is going to have to be pulled and your credit report is going to have to be pulled. Number two, is it going to make an impact on your score? Yeah, probably. Yeah. It might be 2, 3 points, 5 points. Number three, if that difference of 2 or 3 or 5 points is enough to move you down to where you don't qualify for the new loan, that means you're too close to the edge anyways, and you shouldn't be applying for new debt right now. All right, if you're within 5 points of qualifying, that's kind of right on the bubble. Yeah. That's where you would need to talk to somebody like Matt at VIP Financial and his coaches and talk about, hey, what are the steps that I need to do to get my credit improved, to pay off some of my revolving debt, to actually get to a better spot. So I hear it all the time when people say, I don't want to have my credit pulled because I don't want my score to go down. Joe, I have an 800 credit score, take my word for it. If you have an 800 credit score, your rate's going to be the same as if you have a 797 after I pull your credit. So if you're serious about buying property, serious about getting a new house, getting a rental property, let your mortgage professional pull your credit. You want to talk to 2 or 3 or 4 or 5 people, you're probably not going to see a big impact on your score on the 2nd, 3rd, or 4th hit. Now you pull your credit 15 times, you might start to get impacted. 1, 2, 3, it's not going to be a big deal.
I think that's really terrific advice, and I think that should carry over into the DTI, which is an acronym for debt to income ratios. If you're teetering on the edge of what's approvable and what isn't, because you're at 46% debt to income ratio and they'll allow for 50, and all of a sudden this $300, $400, $500 change of minimum monthly payment requirements puts you past the minimum or the maximum debt to income ratio requirement, you're too close. You're buying a property that's too expensive for you. You need to stop with the emotional decision making and get into a position where everything is conservatively affordable.
That's right.
And so I think that's really great advice.
Yeah, don't buy at the top of your price range. This is another thing that I think I would say is number 2.
This happened to me almost every single time I did a loan.
Yeah.
It was just people that they would say, that was where I would start. What is the maximum you can afford before even $1 more, and you're saying, this is too uncomfortable, I wish I didn't buy this property.
That's right.
And I can't even begin to tell you what percentage of people would come back and not only try and get to that exact purchase price, but try and convince me that $5,000, $10,000, $15,000, $20,000 more was somehow justifiable. Oh, my truck's gonna be paid off in a couple of months, I won't have that payment anymore. Guys, listen, just because the banks are willing to lend in certain cases at a certain debt to income ratio or at a minimum credit score, it doesn't necessarily mean that 2, 3, 5 years down the road, you're gonna feel as comfortable about it as you think you will when you're getting into it today. So really shoot for almost unnecessarily conservative decision making when it comes to your money, and you'll be much better off for it.
Don't buy right at the top of your price range. I meet people all the time who say, Joe, I want to know the exact maximum that I can qualify for, and I plug it in. I'm like, okay, it's $340,000. Okay, well, I'm not going to look at that because I really want to be only about $300,000. Now, if I've told them their max is $340,000, guess what they come back at 85% of the time?
$345,000.
$345,000. Here's my price, it's $345,000. Joe, do you think you can get us an 1/8 of a percent lower on the rate so we can qualify? I guess we're gonna have to, right? Don't buy right at the top of your price range, because guess what happens 3 months later? You have what I call the unexpected cost of home ownership. You buy that house and then you want a new couch. You're tired of the Scooby-Doo sheets hanging on the windows, and so you've got to get regular window coverings. That costs another $1,000. You need a new dining room table. You want a new pool table. You want whatever. All of a sudden, you've spent a lot of money, and that $345,000 house is pretty darn expensive. So buy well below your maximum. Now, I'm not saying if you can afford $340,000, don't buy a $150,000 home. I mean, maybe you find a $150,000 home that makes sense, great. But don't purchase right at your maximum. Give yourself a little bit of leeway, because you never know when you're gonna have a broken refrigerator. You never know when you're gonna have a flat tire on your car. What if you have another baby and your half of your monthly income is going towards your housing expense? Are you gonna be able to afford to have another child, right? Think about that. Think about the long term. Don't buy right at the maximum. So I'd say that's number 2 on the myths and mysteries that we run into, is don't always be shopping at exactly that maximum price range.
So your pre-qualification letter is not necessarily a permission slip to go out and spend the absolute max dollar amount on that letter. Okay, so we've got 2 now, right? So what was the first one?
Number 1
is going to be so injured that you shouldn't move forward, and number 2, that pre-qualification amount is somehow the amount you should be shopping for. It should always come in less than that. What would be the third?
Number 3, I think, is down payment. I hear folks a lot of times, Joe, I don't have 20% down to buy a house. You know what? 20% down is not required. Now, maybe that was true in the 70s, 80s, first part of the 90s, but over the last 20 years, certainly as long as I've been doing loans, you can buy homes with as little as 3.5% down, 3%, 5, 10, 15. Of course, there are options for 20% down. But let's talk a little bit about some of the debt weapons and some of the strategies that you teach your students on how you can buy with less money down.
Yeah, I think that's a good point. I mean, here's the thing. Just because you're required to supplement what that first mortgage provider is allowing you to borrow from them doesn't mean it has to be your money. And I think that's what the debt weapons have allowed our audience to benefit from for almost a decade and a half at this point. And so Joe and I have worked together in the capacity of helping people understand that they can source this from many different places. And of course, the down payments and those requirements are different whether you want to live in the property or whether you want to buy something for investment reasons. Buying something for investment reasons might require a higher amount of supplementation than buying something for your own personal use. So we've obviously navigated this thousands of times collectively, and one thing that debt weapons can do is give you the money that you need to put money down on a property, whether it's one you want to move into or whether it's just getting those residual and alternative streams of income started. So guys, debt weapons is a key part of this. If you haven't yet filled yourself in on what those are, make sure you tune into the other videos on this channel. If this is your first time viewing something here on VIP Financial Ed, we talk all about debt weapons in as many videos as we can. So get out there and start looking at some of the other titles and familiarize yourself with these various tools. But long story short, they come in thousands of different formats. We talked a little bit about a debt weapon in the form of credit cards being acceptable if you were to draw certain credit card accounts as down payment formats. And this is something that we've done for a lot of years because of the low to 0% introductory periods that credit cards can offer as a benefit. However, in spite of being in favor of this plan, we do it very differently than what I've seen taught elsewhere, which is we protect you as the borrower so that you do not get stuck 12 months, 15 months, 18 months down the road when that promotional period is expiring with a retroactive penalty of interest. And guys, when that comes and catches up with you, you're talking massive sums of money. So don't get stuck in that juggling act of 0% credit cards. We actually favor other forms of debt weapons using this strategy of supplementing for down payments and fix-up costs and even vacancies and other types of emergencies. So great point. You don't need to have your own money for this, but people like Joe and I will work in tandem in order to help you guys get this structured in a way where as long as your debt to income ratios meet the maximum that you're allowed to have and your FICO credit scores meet the minimum that you're required to have, this is one of the coolest things out there, and we can then quickly turn around and pay them off so that you start owning a portfolio free and clear. And Joe teaches a lot about that too.
Some debt weapons that people forget about. We talk about credit cards, HELOCs, business lines of credit. Don't forget about your life insurance policy. All right, I recently had a customer who had a life insurance policy that his parents had gotten for him when he was a baby through a television commercial, and they'd been paying into it, and it had actually built up a balance of about $8,000. Guess what? He contacted mom and dad and said, hey, can I take that cash value out so I can use that as my down payment? Absolutely, we've been saving that money for you, all right? Savings bonds. This was another one of my favorites. Talking with a client, she's like, well, I have all these savings bonds. I don't really know exactly what they're worth. She brought them in. There's an online calculator that you go in, you punch in the savings bond number. She had more than $20,000 of savings bonds that her grandmother had been giving her for every Valentine's Day, Christmas, Thanksgiving, birthday. And she had these coupons, and it was so cool because it said, Happy Valentine's Day, Happy Thanksgiving, Grandma in 1984. And we put all those together. She took them down to the bank, deposited them. It was $20-some-odd thousand to help her buy a house.
How cool.
So debt weapons, and you know where these were at? These were in her sock drawer, is where she just had them saved. So these things could be all around you. You just need to talk with a professional like myself or the guys over at VIP Financial to really brainstorm on where those are at.
And that's the thing that, while the bulk of the most popular debt weapons that we pursue do come from financial institutions, as Joe's alluding to, many of them actually have nothing to do with financial institutions. That's right. And that's why a lot of people that have great cash flow can still benefit from debt weapons even when their credit is struggling, because you can go out and get an infinite banking whole life insurance policy without any credit inquiries against you at all. You can have 500 credit scores and you can open a policy. So we love the infinite banking concept. We do teach about it here on this channel. We do have an expert that we're aligned with. His name is Nick Fortune. If you haven't seen any of the videos with Nick, make sure you check those out. He does talk a little bit about Trump's new tax plan and what to expect with that. And we also talk about whole life, and we will be putting out and releasing new videos as we come into the next year. So guys, I just cannot stress enough that familiarizing yourself with your options is going to be how you can think out of the box and get into things that the ordinary borrowers can't, and or just aren't familiar enough with. They can, they just aren't aware that they can. So ignorance is expensive, it's not blissful. So what would you say is the fourth most common myth that you're hearing?
Number 4 that I hear about a lot of times is, hey Joe, I don't have 20% down, and I heard there's this first-time down payment program, or first-time buyer down payment grant program. I want to do that because I want this free $10,000 grant so that I can buy a home and not have to put down any money of my own pocket. Now, Matt, let me ask you a question. Has anybody ever given you any free money? Anybody just ever showed up and said,
blockchain. My banks are giving me free money by lending me money to buy Bitcoin.
But for the most part, there's some sort of cost associated.
Yeah, exactly.
Right?
There's a cost.
There's a catch.
Yeah.
So what a lot of people don't understand is these down payment assistance programs for first-time home buyers, it comes with a $10,000 grant, but guess what else it comes with? An interest rate that's maybe 1 or 1.5% higher on the bulk of that mortgage. Now, one of my favorite sayings that I learned from the great Matt Pillmore, interest rates are
interesting, people.
Okay, but if it is more expensive on the interest rate, that monthly payment is going to be more expensive. So if I bought a $200,000 home and I got a $10,000 grant as my down payment, yet my payment is $100 more per month, just $100. But I keep that property for the entire 30 years, 360 payments times $100 a month. I've now paid an extra $36,000 on that property for a $10,000 grant.
Hardly a free grant, right?
Right. Now, these grant programs are great. I use them. I have clients that use them. But what I encourage everyone to understand is, what are you getting into? It's not free. There is a cost associated with it. And what's our long-term plan to get you out of that higher interest rate and get you into something that's more affordable, maybe using a debt weapon, maybe using principal reduction or refinance. So make sure you understand, if you're getting into a plan like that, what's the long-term ramifications of it.
I love that. That's a great piece of advice. And finally, the fifth. What's the fifth myth?
Self-employed borrowers. I hear this all the time. Joe, I'm self-employed. I can't get a new loan. It's not true. If you're self-employed and you claim no money, no income, it's true. You can't get a new loan.
Right, exactly. The banks want to know that you're actually generating revenue.
That's right.
Adjusted gross income can't be zero, folks.
That's right. Are you paying your taxes? Are you reporting your income on your tax returns? If yes, please call us. We'll give you a new loan. I do loans for about 30% of my clients are self-employed that have been turned down by other financial institutions. And some of them, they call and they say, you know, I called my bank and they just said they don't lend to self-employed people. That just means that the bank simply doesn't understand how to do it. Not every bank offers every program. So make sure you're working with a professional that knows how to do that. And that's where the guys over at VIP are going to connect you with the right professional for your particular circumstances.
And I think that's a really interesting topic. Let me ask you a question then, because for years and years, I've made it a point to actually deduct fewer expenses than were qualified tax breaks in order to pay more in tax in order to stay as lendable as possible. What are your thoughts on that?
So I tell everybody every year on April 15th, you make a decision. Am I going to pay no taxes and buy no real estate this year? Or am I going to pay taxes and potentially qualify for loans and buy real estate this year? Every year on April 15th, as a self-employed person, you decide, how am I going to allocate whether or not I'm going to be able to borrow money this year? Maybe there's a year that you say, you know what? I'm writing everything off because I don't need to buy another property this year. Okay, cool. But what happens if you roll into December and you need to buy something? You've kind of messed up because you already filed your taxes 8 months ago.
And keep in mind, most of the most popular of our debt weapon collections require debt to income ratio requirements to be met as well. These are not always stated income, stated asset products. Sometimes yes, and that also fluctuates based on economic conditions, folks. So if the economy is really good and it's bullish, then we can see banks loosening up and offering lending tools that maybe don't require a whole portfolio of documentation. If the market is really tight and the banks have constricted, then of course they might be wanting more documentation. But it is very interesting to me that this 15, 16, some odd $1,000 of profit that we've generated from our crypto investment recently, that came from a debt weapon that I would have never qualified for had I chosen to take all the tax deductions that I was allowed to take. And so just keep in mind that the taxes I paid for that year have been exceeded by the profits now, the extra taxes that I paid that allowed me to get access to that tool. Being lendable and the opportunities that come from that are often far more valuable than the taxes that you can prevent by being as savvy and trying to get every write-off possible. So I love paying taxes. I know a lot of people that don't. I do think having a great tax plan in place is really important, but I don't think getting away with paying as little or even nothing in taxes is the best strategy if you want to create extraordinary results. So guys, this is our list of just 5 common myths of financing. Obviously, there are many, many others that we can cover. As I said in the beginning, we're going to continue to have Joseph back here on the channel as often as he's willing. A wealth of information. He's been in the industry as long as I have. Guys, he's seen the good, the bad, the ugly, and he knows what is going to happen when the market changes again. So we want to be a key part of this so that you guys are prepared as well. If you haven't yet done so, make sure you hit that subscribe button along with the bell notification next to it, which will send you alerts whenever we are dropping new videos. Also, make sure you hit that like button as well. We want to know if this is a video that you want to see. Again, if you want more content like this where we can help you navigate the complexities of the financial borrowing world, then we need to know it. So make sure you hit the like button. Also, put some comments below.
Love comments. We want to know what you want to know.
Exactly. Any questions that you might have that we can ask Joe next time he's in the studio, please make sure you throw those below as well. And finally, we are going to go ahead and set you up with Joe if you need a great lender, if you need somebody, and it doesn't matter where you live in the country, Joe can help you if you are here in the Denver, Colorado area.
Colorado,
That's right, all of the state. And anyone else outside of the state that wants great expert advice and guidance, we can make sure that you're connected with somebody there as well. So we'll put the email address in the comments section, or I'm sorry, in the description below. Contact us at VIPfinancialeducation.com. Go ahead and throw mortgage big and bold in the subject line, along with your contact information in the body of the email, and we'll go ahead and send that over through a warm introduction to Joe. I'll make sure and commit to doing that personally for you as well. Lastly, we are going to go ahead and give everybody that tuned in today a gift. Joe has been nice enough on these videos that we're doing together to give you guys a copy of his investment spreadsheet. This is an analysis worksheet that I have yet to see competed against. I mean, this thing is absolutely comprehensive with what you need to be considering if you're going to be moving forward with one of your investments that you're considering with. So if you're thinking about a property and you're not running it through this worksheet and looking at some of the forecasts, guys, you're probably making a mistake. You may be missing something. So this is one way that you can quickly and easily determine if you're looking at a property that you should be moving forward on, right?
It's a terrific spreadsheet. It takes probably less than 2 minutes to fill it out once you're familiar with it. It's going to give you cap rate, investment, or your internal rate of return, your cash on cash return. It's going to break out your cash flows over the next 15-year period. It's really going to give you a lot of information to quickly decide, is this a property that I want to buy? Or let's plug in your existing properties. Is this a property that I want to keep?
Ooh, I like that.
And I think that's a really important point that we should all be looking at.
I think that's great. And so guys, if you haven't yet already checked out the video that Joe and I did regarding how to use that investment analysis worksheet, make sure you tune into that because he'll walk you through it real easily. That is a free gift from us to you today just for sitting down and checking out some of these great talking points with us. The link for that will be in the description below as well. So go ahead and make sure you get your copy here today. And until we see you on the next video, guys, make it a great day today and take care.